So now we are in step 3, where we've mentioned that the Federal Reserve Bank needs to study the other factors that cause changes in reserve positions. Now we've mentioned the other factors before when we studied defensive open market operations by the Fed. However, we will look at some of these factors in more detail. Now these are not an exhaustive list of factors, but some of the factors. So we get an idea of what these external factors are that cause changes in reserve positions. So we've mentioned before that the Federal Reserve Bank, along with dynamic open market operations, performs defensive open market operations. There are market factors that affect the level of reserves at any given point. If the Federal Reserve does not conduct these defensive open market operations, the reserve positions and the Fed funds rate can fluctuate wildly, sending the wrong signals to the market. So let's briefly look at a few of these effects on the Fed fund rate. Now the first one we can look at is the discount loans. We've mentioned that the Federal Reserve Bank acts as a lender of the last resort, ready to provide banks with liquidity through its discount window. Since these loans are made at the initiative of the borrowing bank, the Fed has little control over the volumes of loans. As we have seen in recent years, the Fed has relaxed norms for borrowing through the discount window, and these borrowings cause the reserve positions to fluctuate. Now another factor is currency in circulation. We have seen that the currency ratio C is the amount of currency divided by the size of checking deposits. Currency increases in the hands of the public cause a depletion of cash in bank vaults. Now, post the 2008 recession, due to the public's mistrust of the banking system, the currency ratio went to record levels since the currency held by the public increased dramatically. This increase of currency in the hands of public increases the amount of reserves borrowing by banks, since now banks have less cash in vaults. Another factor which affects the reserves position is the Federal Reserve float. Now, float in the banking system is the funds that a bank enjoys as idle funds that do not pay interest due to delays in the payment system. So the Fed float is best understood with an example. Let's assume that Guess in New York sends a $10 million check to, let's say, a company called Denims in Los Angeles for the payment of materials. Now Denim deposits the check at its bank in Wells Fargo. Wells Fargo sends it to the regional Fed for clearing. The effect of this transaction on the balance sheet of the regional Fed would be the assets would change. The assets would increase. Check collection from Chase would increase by $10 million, and deferred credit on the liability side would increase by $10 million. So this deferred credit is a provisional liability since it's not realized yet, and since it's owed to Wells Fargo, it's a liability. So in case the check bounces, Wells Fargo cannot draw upon this amount till it clears and is therefore not counted as part of the reserves. Since Guess's bank Chase owes the Fed the $10 million, it is considered as a provisional asset. Now, even if the check does not clear in 2 days, Wells Fargo gets credited with the $10 million. However, it still needs to pay interest on the amount till the check clears. The regional Fed needs to send the check to the New York Fed, who in turn will present it to Citibank. So the balance sheet of the regional Fed would look like this. The deferred credit to Wells Fargo would decrease as a liability by $10 million, and the deposit of Wells Fargo at the regional Fed would increase by $10 million. The effect of this entry has an impact on reserves, Wells Fargo has gained an additional $10 million in Fed deposits. Since this is a deposit at the Fed and Chase's deposit is still not debited, the total reserves in the system increase by $10 million. Now, when the check gets cleared by Chase, the effect on the Fed balance sheet would be the assets would decrease by $10 million, the check collection from Chase would decrease by $10 million, and the deposit of Chase would decrease by $10 million. So we see that on the day of Wells Fargo being credited the $10 million in its account, the reserves increased by $10 million. Now this increase is due to operational factors and not intentionally by the Fed. On the day the check is cleared by Chase, the reserve position falls back down by $10 million. Now, with thousands of checks flowing through the clearing houses each day, the amount of checks in the process of collection is always greater than the amount of deferred credit items. Since we saw that the Federal Reserve Bank squares the deferred credit items on the balance sheet despite not citing the funds from the drawer's bank, we see that the amount of checks in the process of collection will always be greater than the amount of deferred credit items. So the Fed earns interest between the time the deferred credit items are squared and the funds are collected from Chase. Now this is called the float. This is the float earned by the Federal Reserve Bank. So the Fed float is equal to the items in the process of collection minus deferred credit items. Now for more about the float, one can read about the float in the New York Fed site. Now next we will look at the fourth major factor that creates disruptions in the federal funds market, which are the US Treasury's payments and receipts in its general account.